Let's look at managing the most important risk of all, the revenue risk. This is the risk that the expected project revenues do not materialize. That's the income that you are expecting, the cash inflows, and by now you'll have identified that this would be a disaster. If that happens, after your project has closed, it is a disaster because there will not be enough cash inflows to service your loans. That means the project company cannot pay the interest and contractual loan repayments, and then the project company will be in default, and it may even go bankrupt. Even before closing, in the preparation phase, this would be a disaster. If the investors or lenders identify that revenues could fall away, then no investor or lender will give you the funding that you need. In that situation, the project will fail even before it starts. Usually when people complain that banks are not prepared to lend them money, that's because they have been unable to convince these banks what the expected revenues will be and how secure those revenues will be. And so in the preparation stage and in the project operation stage, it's crucial that you know what revenues the project company can expect. When we spoke in the previous video about stabilizing revenues as a crucial act of risk management, this will be the top theme that we focus on. Before we can start to secure the revenues, we need to determine what are the potential revenues. For this, we will need to determine how much of the product or service the project can realistically produce. For example, how many megawatts of electricity it can generate, who the potential buyers for this product and service are, and what their demand will be in the coming years, and what price they will be prepared to pay. When you have this information, you can calculate the future expected cash inflows. The revenue that we are trying to assess here is the quantity of products we sell times the price per product. Now let's look at how secure these revenue flows are and how we stabilize them. Pause this video a moment and think about how you would do that. Did you think of a solution? In project finance, whenever there's a market buyer, we aim to sign an off-take agreement. This is an agreement with the buyer that states that the buyer legally commits to purchase the product for every year and for a contractually agreed number of years. This contract needs to specify the quantity of products that he will purchase, the price at which these will be purchased, and it needs to specify a period over which this purchase commitment runs. Usually, this must be at least as long as the term of the project loans, because the project lenders are the most risk averse. They will need the comfort of an offtake agreement at least as long as the loan is outstanding. Then also, the offtake agreement will specify what happens if the product is not purchased. Usually the buyer will be liable for a penalty. We call this a take or pay contract because you either take the product or you pay the penalty. Negotiating an offtake agreement will be tough because the buyer will not be keen to give such a large commitment and for so long a period. It will mean that the buyer assumes the market risk, the risk that there may be less demand for the product in the future, due to an economic downturn, for example. He assumes the price risk, the chance that the market price of the product falls in the future. We have, for example, seen in the economic downturn recently that the demand for electricity has fallen, and so did the price. If our power project company had signed an offtake agreement, then the power utility company, its buyer, would have borne this risk, and not our project company. The buyer will not take on this risk unless he gets a reward for doing so. It may only be prepared to pay, for example, 95% of the current market price, a 5% discount being the reward that is assumed for assuming this risk. For the project company, it will be a trade-off between the lower but more secure revenues, which also means cheaper funding, or the higher but less secure revenues, and more expensive project loans. If the project company does not have the security of an offtake agreement, the lender will run more risk and he will require higher funding costs. The saving on funding costs can outweigh the lower revenue. Finally, not all projects produce a product that can be sold. Imagine a project company that has been given the concession to build a stretch of road and to make that road available. In most countries, road users do not pay for the use of a road. How could the project company be given the opportunity to raise revenues that it needs to fund this road investment? Pause the video to think again about this. In broad terms, there are two basic earnings models. First, the road users could be asked to pay. The project company could charge toll fees for accessing the road, and these toll fees would need to be sufficiently clear and predictable to satisfy the lenders. A second alternative would be that the concession giver, usually a government, agrees to pay a fixed price for making the road available. This model is often referred to as PFI, or Private Finance Initiative, and it's a form that was first applied in the United Kingdom. It has the benefit that the project company does not run any road usage risk. It will get a fixed fee per day the road is made available, irrespective of its use. Variations in the road use are no longer relevant for the project company. A government is usually better able to predict and to influence the use of a road, for example by setting the costs of fuel and car ownership, or by creating public transport alternatives. That is why this model is particularly efficient in allocating the risk, in this case the road usage risk, to the party that is best able to assess and manage this. This financing model is often applied here in the Netherlands. When we look at some legal aspects, we'll look more closely at the legal alternatives that exist to manage this revenue risk.